Fred, welcome to the channel. Very excited to have you.
Oh, thanks for having me, Dimitri.
So, I'm guessing a lot of people don't know who you are. Why don't you jump in a little bit on how did you get into finance? And then we'll go down the rabbit hole of what you're currently working on at Avo Labs and kind of how that process got built out.
Well, thanks. I was born into finance per se. My father had a seat on the New York Stock Exchange back in the 80s, early 90s. I knew I'd always wanted to be involved with stocks just from going into work with him. Um, he also had, racehorses growing up, so we would go and schedule our summer vacations around where they were racing. So it was either between Monmouth Park or Saratoga. And I learned betting and probability and all of these trading anecdotes over the years of just going to the racetrack. And it was just a natural progression for me to get into finance.
When people say they go to the tracks, right, and you learn the probability theory, are there actual data sheets that you're looking at, or is it more or less like you're just looking at the last three races, or like how do you start getting into that process of betting on horses?
Well, when I was young, like really young, I would just look at the colors on the jockeys and the horses and bet according to that. But then as I got older and learned how to read and read racing forms and stuff, then you would access like prior races and if they like these track conditions and stuff like that. And there's a whole bunch of information available to try and gain an edge at the track. It's it's a process, and you know, I bring my kids to the track now, and my wife says I ruin the track for everyone, but I'm like, no, you don't understand the track. Like this is what you're supposed to do, and this is how it goes. Um, it's a lot of information to process, and there's some parallels to finance and trading where you're looking at past performance and you have to try and extrapolate current competition, current conditions to how horses are going to fare.
And when your dad was on the New York Stock Exchange, did you know what he did? Or did it take time to
No.
figure it out? Did you ever get to go down there?
Yeah. Eventually I figured it out. I thought he was stockbroker. But that was actually not what he was at all. He was an equity trader. And it was just love going into New York from northern New Jersey, taking the ride with him on the PATH trains. It was just everything about it was just awesome. The hustle, the bustle, the noise, the mess all over back when it was, paper everywhere. Again, there were similarities between that and the track. The track, of all these like bet papers all over the floor and stuff. And it was just an experience that it was a shared experience. And from that, I was hooked. I saw the numbers and the screaming and the yelling back and forth and just the excitement. And yeah, it was a natural fit.
So after you got interested in it, right? Your dad's working on finance as well. Where was your path on choosing a college degree, going that route? Like, how did you make that decision?
So I knew I wanted to go into business school. I thought finance. And so first year of Villanova, you take all your elementary classes, and I hated accounting. It was the worst experience. I did fine in it, but I was just like, this is miserable. So when choosing my major, I simply looked for the one with the least amount of accounting classes,
Okay.
and that was economics.
Okay.
But it turned into a blessing because I was really captivated by like time series analysis and other econometric models. So it all worked out like
Yeah.
very well.
For me, it was mind blowing. I remember in undergrad, I had no idea what I was going to do. My dad's in business. You might as well go into business.
Yeah.
And then I chose finance because, there's always the ranking of like hierarchy of, the finance students think they're the smartest. And then it goes down to like accounting and marketing and operations and all that. But I remember taking the economics classes and just being mind blown like, this is how the economy works. it's hard for me to put myself back in that position of realizing, like, when you're in high school, you typically don't have an understanding of what markets are, supply and demand. I mean, you hear like the buzzword hand wavy, like, oh, supply and demand dictates price, and people are like, yeah, 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 and they all move on. But I remember that process of taking like classes on like, looking at utility theory, looking at curves, especially when supply and demand is linear. And then we come to this conclusion later on, it's not linear. And so then you're like, oh, we could actually do some real math in this space. Um, it was definitely, I think, an enjoyable process. I think the economic space as you got deeper into those courses. I think just kind of a new perspective on the financial space as well, compared to other majors.
Oh yeah, I mean, my first thought when getting introduced to time series analysis was I'm going to apply this to stock prices. That was because I grew up with CNBC on in the house like 24/7. Like that was the what my father would watch as soon as he got home, and everyone else had to watch it. So I knew where I wanted to go with it. Um, and you fiddle around, you learn, hey, well, maybe this doesn't work so well. Trying to forecast stock prices with classical econometric models.
Yeah.
Um, but it's a fun exercise anyway.
It helps set your foundation. Because I think it would be crazy to try to teach somebody from nothing to skipping all the fundamental foundation and then jumping into more complex methodologies.
Hmm.
I think it's a good foundation of like, these are simple tools. This is a moving average, like trying to figure out how the parts are working. So that when you do finally get into more practical applications, it's like you have, I guess, the ability to judge what is and isn't working.
Oh yeah,
There's far too much backtesting now. Like I made some theory and I backtested it and it worked great. And it's like, does it have a theoretical underpinning or are you just, doing regressions, which I often see in the investing space?
yeah. Well, I mean, the older I get, the more experience I have, the less reliance I put on back tests, and the more I do on just out of sample testing. So, I mean, I can go through a trading strategy and validate the logic, you know, piece by piece. And if it's doing what I think it's doing and saying it's doing, I will give it a chance to work and prove itself. Um, Again, you've never seen a bad back test when everyone overfits, historical returns, and you could do all sorts of like walk forward testing and time series and embargoing data and stuff, but inevitably you're overfitting something along the way, and just there's a million and one different avenues to capture out of sample performances,
Mhm.
either with a minimal amount of money or like a paper trading account, or third party trade capture
Yeah.
um, sites and stuff. So try it. I don't rely on the back test as much and as you would just out of sample live.
Yeah. I unfortunately ran into a guy that had a great idea similar to this. And then he tested it on money for a small amount of money for like 6 months and it worked stellar. So we got a bunch of investors all in. And then the next 6 months, it just tanked.
Yeah.
So I asked him what happened. He goes, there's a regulatory change I didn't realize.
Okay.
It,
Yeah.
it washed him out.
So I mean that's it, I always use this example. I've built so many trading strategies on so many different products over various time frames that just like in the Iron Man movie, in the first Iron Man movie, when they go to recreate Tony Stark's suit and they fly up into the atmosphere, and he looks over, he goes, "Oh, did you fix the freezing problem?" He's like, "Oh, what freezing problem?" Well, you do this long enough, you get to see many different types of freezing problems and other different problems. And it's just, a culmination of trial and error. And you have to be able to be wrong to
Mhm.
grow and learn from it. And the key is to how do you minimize your risks and losses while being wrong. So
Yeah.
that's one thing, I see it all the time. People just use obscene amounts of leverage right from the beginning and just
Yeah.
always ends poorly.
Oh yeah. Well, it's the problem of you look at the probabilities of it and you go, I've got like a 51, 52% chance of being right, which is obviously better than being wrong. And so then they leverage it, but then they forget, you could be leveraged on the wrong end of that as well.
Yeah, I mean, some of my best strategies were right. The win rate was around 40%, a little less than 40%. But you're very asymmetric on your gains versus your losses. So if you're wrong for one contract in a futures trade or 100 shares in an equity trade, but when you're right for eight contracts or 900 shares. So
Yeah.
again, I don't focus on win rates as much as other people's do. Like I like the ability to be wrong and still stick around.
I think that's key though for a lot of funds,
Oh,
right? Right. We're not
yeah.
we're not focusing on the longevity, especially in academia as well. You're missing out like drawdowns and looking at other issues that you're running into when you're running these funds. And there's always that longevity piece of maximizing the upside but minimizing the downside simultaneously.
Yep. And that's what I try to do all day, every day.
So what was your first job then? So you went through this economics process, right? And we'll get on to Avo Labs and partial moments here in a second because this is actually tying into maximizing upside, minimizing downsides. What was the first job though right out of college? Like where were you headed? What were you doing?
Well, right out of college, I'd taken over my father's business. He had actually purchased a janitorial company right out of in the mid 90s, I think it was. And we had, 250 guys working for us, cleaning supermarkets, movie theaters, schools, stuff like that. And it is not what I wanted to do at all. So I graduated in May of that year in 97, and he passed away in August of 97. So it's just assumed that, oh, Fred's out of business school, he can run the business. So, I ran that to the textbook of what I had just learned. Um, Again, it was very unfulfilling. It was not what I wanted to do at all. Plus, I was 22 years old, having to go and meet with all these managers and stuff, and no one wanted to take me seriously because I was so much younger. Grew a beard, so I'd look older, and people would take me more seriously. But so I'd actually got my father's friend to help out with the business, and then let him run things predominantly while I went to Morgan Stanley initially for my first Wall Street job out of college.
How did your dad start the business? Did he retire being side or did he just doing both?
Yeah, he didn't golf, so like he was just bored.
I gotcha.
Um,
I face that similar thing. I mean, everyone goes, you have a million hobbies. I'm like, I don't golf. I don't watch sports. I got to pick something to work on, right?
yeah, and so that's he just saw this business opportunity and grew it based on existing connections he had, and it all worked out great. But again, I didn't go there to learn how to run a janitorial business. That was
Yeah.
not what I had in mind. So Morgan Stanley, I was again the junior guy, get coffees and load up the models and stuff, and call up the brokers and get quotes, and we would write them on a clipboard with pencil and paper. It was on the distressed debt desk, which was
Okay.
newly formed, and this was like 1999, and there was nothing distressed in 1999 in the U.S. The economy was booming, stock market was booming, and
Yep. Tech was running high.
yeah, they were trading, non-performing Japanese bank loans that those banks were getting rid of and stuff, but there were very few like domestic deals going on. It was interesting, a part of the market I'd never been exposed to really.
Hmm.
Um, but again, I wasn't like exhilarated by it. And a friend of mine had reached out. they had ideas of starting a day trading office,
Yeah.
and they're like, oh, Fred knows the market, get him to help out. So I took a vacation from Morgan, and on that vacation, I went into this day trading office every day, and these guys were just printing money. And I was like, wow, this is like shooting fish in a barrel. And
Okay.
so I left Morgan Stanley to join these guys full time and partner up, and they needed a Series 24 for the office, and so they're like, "Oh, Fred, you know the market, so you study, you take the Series 24, and you'll be the registered rep for the office and stuff." And so I did that, got all my licenses, and then started getting into trading Nasdaq stocks back in 2000, late 99, 2000, 2001. So I caught that whole bubble up and subsequent crash. And I would trade personally like 20% of the daily volume on it, like a handful of Nasdaq 100 stocks.
Okay.
Just, launching orders left and right in these level two boxes. And, you hold positions for anywhere between a couple minutes to a couple hours, but generally you were flat every day. And it was great, great business. Made a ton of money doing it. And then decimalization came and tightened the spreads immensely and changed the whole nature of that game.
Why don't you explain that to some of the listeners? I don't know if they understand the difference between fractions, the fractional, and then the decimal systems within the exchanges. Most young guys have no idea. They just think decimals come through the system.
Oh, yeah. I
It
mean,
works.
well, back in the day on the CNBC ticker, there used to be fractions going across the bottom of the screen. And so you learn quickly, like, how to calculate an eighth in your head, and obviously a quarter and 16th. And at some point, they felt, oh, we need to make this into decimals instead of fractions. And
Okay.
it was both good and bad. I suppose spreads tightened immensely. So that's good for an individual trader and an investor because you're getting a smaller cost you're paying. But on the other side of the business, it hurt because there's simply less money to make back and forth on these smaller spreads. Then we got into like different forms of rebate trading, where you're sitting on like bids and offers for very non-volatile stocks like Cisco, like after the crash,
Yeah.
didn't move, but it printed hundreds of millions of shares a day of volume. And it was really just these rebate guys back and forth providing liquidity on both sides of the market. Um, Not nearly as exciting as the bubble and the subsequent crash were.
How did you guys do when it popped? Were you guys caught flat-footed, or did you guys position fairly well that you didn't take too much of a bath?
When the market crashed,
Yeah.
oh no,
The
we
tech
were
bubble.
short.
Oh,
We
perfect.
would short everything.
How did you know it was coming? Was there a pattern that you guys recognized, or was it a
No, it would just you would see bids just disappear, like in in the level two box. You go to hit someone for size, and they maybe give you like 500 out of 5,000 shares that you were trying to sell at that point.
okay?
And
But
then you would skip lower and lower and lower, and there's the volatility associated with that. I'd never seen anything like it. You'd have stocks moving 10% a day, like that. And these were the big Nasdaq 100 stocks of the day. So imagine like a Nvidia or an Apple moving 10% a day, and the
yeah,
implications from that. We got a glimpse of it. We got a glimpse of it earlier in April. And that was the closest I had seen to those 2001 days. But it,
is it the liquidity becomes patchy? Is that part of the issue? Like you're mentioning, you're getting ready to set a trade. You need 500 shares moved, and then like 50 are clearing, And so then you realize like there's a lack of liquidity within that piece.
Yeah, it's not even like they just leave, like bids leave, and they gap down to lower and lower levels. That's been remedied somewhat with these decimals and tighter spreads and generally more liquid books. But again, high frequency traders, they're not mandated like market makers to stand in there and provide liquidity. So when they leave, things get very thin very quickly
Okay.
um,
I gotcha.
on a single side of the market.
And so what did you do after that firm? Like why did you leave and what was the process?
There was a difference of opinions. I thought we should transition into futures and commodities and different markets because decimalization had such an effect on the underlying equity space. And they didn't want to move or change. So
Okay.
just agreed to disagree, and I transitioned into commodities.
Okay.
Traded those.
Did you do another big firm or did you do it solo?
No, it was a smaller firm locally, and it was a learning curve. So I went into,
I can imagine.
yeah, again, finding out the freezing problems. So I went into trading S&P futures, thinking I would move the bids and offers around like I did in these individual stocks. And it was just I was 24 years old at the time, full of energy and ignorance. And yeah, no, it was an ass kicking initially.
Okay.
It was like, oh, I have to approach this from a much different perspective. And so you adapt, and you learn the characteristics of each market, and they're very different, very, very different. But you appreciate that when you're in the trenches of all these different markets. So I got into commodities. It was index futures, then it was like metals and energy, and then agricultural. So basically, the full spectrum of commodities after that. And there are some markets still that are crazy. Natural gas is one of those markets.
Mhm.
Um, Palladium is another thin market. Um, but I experiences with all of these. I mean, I was trading natural gas when Katrina hit,
Okay.
and those moves were beyond anything I saw with stocks. It was crazy. So then you learn to appreciate, weather forecasting for trading energy futures and stuff, and you incorporate all these different perspectives.
Did you purchase out research on that or did you guys actually work through kind of like the weather research and all the different aspects you're trying to gather?
No, we purchased that. It wasn't a large enough shop where we had like meteorologists on staff and stuff, which could have been useful. Looking back at it. But no, we got into weather forecasting and stuff, and it's interesting, very interesting.
Okay. And then where did you head from there?
Then I got into trading spot foreign exchange, and because the leverage offered there was the siren song I couldn't resist of you know put up just a little money and they'll let you trade 50 to like 200 times the amount put up. And I did pretty well trading foreign exchange, but the hours were grueling. You would finish up New York, then get something to eat, take a nap, and then Tokyo would open, you know, try and get some sleep, and then Europe would open it too, and then rinse and repeat. And it was never the good winning positions that you were up monitoring. It was always like the losing ones that you were like suffering through. And it's like this is miserable. I need to find a better way to do this. So I stopped trading, and I wanted to essentially automate myself. Like, how do I view trading setups? How do I, position them? And I started getting into more mathematically, how I evaluate things. And one of the biggest insights was leaning, and I discovered Mandelbrot and the idea of fractals and self-similarity, and how you look at all these different time frames simultaneously, and they were all relevant to me. You have a minute, an hour, a daily, a monthly. So you're respecting, long-term trends and short-term mean reversion, and came up with the idea of trading these several time frames independently. So if my allocation was, 15 contracts over for a given, like oil, say, then I would take 5 time frames and I would allocate 3 contracts as a limit for each of those 5 different time frames. And I would trade them independently, net them out, and then, put the position in. And that actually helped. It solved a position sizing problem for me, because
Okay.
I put position sizing ahead of exits, which are more important than entries. So
Yeah.
that's my levels of importance for trading. And it generalized. It generalized very well. So I applied this method to the commodities, the foreign exchange, and equities, and I had built out this system that around 2008. This was trying to sell it to funds.
Okay.
Again, 2008, 2009, financial crisis. This system held its own and had a decent return. And so people were interested. And one of the meetings I had with the hiring manager was, "Oh, this is good, but the Sharpe ratio is too low."
Mm-hmm.
And Sharpe ratio is too low. It was like 1.2 or something like that. But in this system, if you're wrong for one contract on any of the time frames, you're wrong for minimal amounts versus eventually being long 15 contracts.
Yeah.
So when all the time frames align up. So it's a very asymmetric, positively skewed return distribution.
Mm-hmm.
And I'm like, wait, this does not make any sense. It's positive volatility that's lowering my Sharpe ratio, and she didn't care. They had their checklist of things to.
The academic checklist. We've done this way for 20 years. Check
Yep,
the box, go through the process.
yep. So, and again, that was 2008, 2009, around then. And I met with a couple other firms, recruiters. Um, One recruiter asked me that, I think it was Renaissance at the time, wanted me to write a 1-page paper on why I felt it wasn't necessary to get a PhD, because they didn't believe I had come up with this system. Um, so then I thought, and everyone, I met with Renaissance, TradeLink, Renaissance was, what was the 0.72 before, it was 0.72, and a couple other firms, Millennium. They all wanted the code.
Yeah, of course. Just show us
They're
your
like,
code. We'll validate it.
yeah, we can help you make it better. I was like, no, it's not what's happening. And long story short, I got away from that experience that, Sharpe ratio mattered to these funds,
Mm-hmm.
why I couldn't figure out. And I needed more of an educational pedigree to successfully sell it.
Which I think is a critical point because a lot of my listeners are convinced they're going to do this with the undergrad. Like, you're going to get this really smart idea, and I'm going to be an undergrad, and everyone's just going to buy it.
Yeah,
I
good
think
luck.
you've suffered through that process, which is you have the undergrad, you have the really smart idea, but no one's going to buy it because, to your point, right? They go through the pedigree of what graduate degrees do you have? Where did you go to school? Who have
Yep.
you talked to?
So in lieu of entering a master's or a PhD program, I thought, why don't I do some research and come up with an alternative to the Sharpe ratio that rewards the upside volatility and presents a clearer picture of the return distribution. So I went back to my old professor at Villanova, explained to him what was going on. He's like, "Oh, you're talking about partial moments. You got to go see David Naraki, who was another professor at Villanova I didn't have."
Okay.
So I go and I meet up with David, and he's like, "Oh, you're talking lower partial moment, upper partial moment. I've been working with these since 1981." I'm like, "Okay, so then why do people still use the Sharpe ratio?" He's like, "Oh, because people just are set in their ways, and partial moments aren't really taught in the curriculum, and you know, people go with what they know." So I pitched to him the idea of the upper partial moment over lower partial moment ratio, and he's like, "Yeah, that makes sense. It's intuitive. It's better than Sortino or other downside only metrics. But you need a utility theory to provide a little theoretical backbone to the metric." So again, with my econ degree, I had limited exposure to utility theory and difference curves and all of that. Um, Heard a little bit about prospect theory
Hmm.
and behavioral finance, but nothing in depth. So David had started sending me all of this work on utility theory to back up the UPM over LPM measure. And it clicked that you can represent these utility functions with partial moments. So what he and I did was basically recreated every known utility function in the literature with a partial moments framework that could capture it.
Okay.
Again, nobody cares about utility theory, and it's unfortunate,
Nope.
but
Nobody does. Nobody does. I brought it up and people kind of roll their eyes and go, yeah, yeah, yeah. But anyways, let's get back to whatever
yeah,
topic we're on.
back to
Yeah.
back to my CVAR or
Yeah.
whatever. But again, any evaluation or analysis you do of a return stream inherently maps to a utility function. So if you're taking expectations, for instance, you're assuming a linear utility function. You're treating all of the deviations, to a degree one, and there's some serious consequences to those underlying decisions that you do. Secondly, Markowitz, when he came up with portfolio theory, spent a quarter of his book on utility theory.
Hmm.
Why? Was he just looking to fill pages, or was it a useful contributor to what are we satisfying with this mean variance objective function?
Yeah.
So I appreciated how he took the assumed quadratic utility of the investor, and that's what mean variance satisfies. And so through all of that work, I figured out how to use these partial moment utility representations that could not only satisfy risk averse investors, but risk seeking and all different utility shapes and stuff. And then I figured out how to embed that directly into portfolio theory.
Okay.
So, but partial moments were the statistical mechanism I needed to do that.
Yeah.
And again, just I have a video explaining the in the presentation, an hour long presentation, how you can recreate the classical variance and all classical, statistics and sigma based statistics with
Mhm.
their partial moment equivalences. And these things have been around since mid 70s. So I'm
Yeah.
not reinventing any wheel. What I did do is provided the rigorous reconstruction and decomposition of classical stats into their partial moment equivalences, all because we treat upside and downside variance differently.
And so I think it's important to note the premise of it, correct me if I'm wrong, is essentially you can take upsides and downsides, so profits and losses, right? And people feel them differently.
Hmm.
Like everyone knows, I'm very risk averse. So when we think dollar to dollar, right, it's not like I vary like a loss of $10 and a loss of $50, is equivalently related on a linear line of, you know, it's
5 to 1, say, or whatever it
yeah,
is.
yeah.
Yeah.
I look at it and I go, I can take a loss of $10. I'm okay with that. The line's coming there. But then all of a sudden my line spikes down on the risk. And I'm looking at a loss of 50 is like, yeah, I'm not even near accepting this. We better get out of this position no matter what.
Yes.
And I think what you're doing with this is trying to explain the difference here, which is if you have a lot of upside volatility, meaning it could go 1, 2% positive, and then it could spike and have a 10, 15% run of profits, that's desirable, right? Most people assume to have that. But when you take the mean and the variance of the entire distribution, you're essentially losing out on that because now you're merging together when you take like an average, the ups and the downs together, and you draw a line in the middle.
Well, yeah, I mean, and even on a more fundamental philosophical level, you take the same return at time t, and it's in your reward, in your mean, and it's also in your risk as part of your variance. So how can the same observation be both a reward and a risk? And I found that to be
An odd concept.
yeah, very unsettling to swallow. And so partial moments avoid that whole philosophical debate of is a return at time t a reward or a risk?
And more specifically, I think what a lot of people don't think about, at least I've never thought about, especially in school, right? You think about you have this distribution, and anything positive is good, anything negative is bad. But often we miss the fact that everybody has a different cost of funds. So how much
Hmm.
it costs to get money, and
Yeah.
I think that's where we miss it. Like a bank might have, 1% cost of funds, 2%, like they get it from the federal funds rate. You get it for free from, deposits. But then you start to look at other sorts of, hedge funds, for example. Like you have capital that you have, but essentially you have like, watermarks and things you have to clear. So your cost of funds starts to kind of creep upwards where it's like a return of 3% isn't going to cut it anymore. The bank might have made a percent on it, but now when your cost of funds is 10%, you don't have you shouldn't take the bet. It looks good, right? It's positive, but it's not a good position to be in.
So that's another, very critical part to partial moments is when you recreate classical statistics, you're using the mean of the variable as the target.
Yeah.
That's great. However, the mean is not really relevant to my cost of capital, and you and I are going to have different costs of capital.
Yep.
So you need to be able flexible with that target, and that's what the partial moments allow you to do. So you can set the target to whatever constraints you have and you're facing, and then calculate your deviations from there and weight those deviations accordingly.
And
And ultimately, when you do that, you're mapping to your risk preference and subjective probabilities to an objective return stream. And that's where the whole notion of utility kind of loses people because they only deal in the objective world. And once you deviate from and incorporate your personal preferences and constraints into this evaluation, now you need to be able to compare across all of these securities, and that's what utility allows.
right.
Um,
And I think that's the difference though between the professionals and the amateur funds is the professionals see the fact that they have different constraints. So there's not a optimal portfolio. Because I feel like everyone thinks like there is the optimal portfolio, and if we all invested in it, we'd all make money.
yeah,
When you start to add on different sorts of constraints, whether it's cost of funds, whether it's rules from investors, right? You can't leverage more than X, or you cannot invest in these sorts of maybe commodities is too volatile. There's sort of rules that changes how the optimization process goes for the portfolio construction. And I think to your point, right, that's where these sort of tools come in, where you can actually build this more granularly instead of just trying to blanket on this generic equation of modern portfolio theory from back in the
I
day.
mean, you just have to look at Kathy Wood and ARK. That is she's YOLOing growth rates
Yeah.
in all of these companies, and it's simply too volatile for most investors who are not comfortable with 60-70% drawdowns. She might ultimately be right, 25 years from now that those were the highest growth rate companies, but at no point is a risk averse investor going to be comfortable with those type of losses?
Yeah.
And that really speaks to the fact that, it might be good for some people, risk-seeking people who are allocating small amounts to it. And Kathy, just maximize everything for me and let's see what we come up with. But she's had a lot of fund outflows, and that's just a testament to the fact that people are more risk averse, and it matters how you get to final wealth. That
Yeah.
path you take is very important.
I,
You've seen tons of funds shut down because of drawdowns that investors weren't comfortable with, however temporary, or they may or may not have been.
yeah. And I think it's a testament to the fact of too many people on Wall Street think they are risk averse or risk seeking because that is like the status quo of like a good Wall Street investor, a good hedge fund manager is risk seeking. But then to your point, when those losses hit,
Yeah,
he's like, hold on, guys, just hold on. We've got this. Like we're gonna bounce
yeah.
back. The majority of them I don't think will bounce back like they think they will. And so they're out. I think it's hard to estimate that
Well,
you
just if you have a 50% drawdown, you need 100% then to reclaim where you were at.
yeah.
So it's just the volatility drag on compounding returns, and that's why minimizing losses is so critical. Further, why isolating downside and upside via these lower and upper partial moments is the most granular way to isolate those objectives.
So,
Um,
so how did you roll this then, this whole partial moments process into Avo Labs? And how did that get kicked off with this? Because to me, it just seems like one big storyline of like, partial moments, Avo Labs, like,
so I started really working on the partial moments and the utility theory work like 2010. And then once I was able to make those associations and recreate the classical statistics and moments from the partial moments, everything else just started falling into place. Um, so I moved on from univariate recreations to then partitioning the joint distribution of variables for multivariate partial moments. And that was my biggest breakthrough, I think, was so I was able to decompose the covariance matrix into four partial moment matrices. So you have,
okay, yeah,
you have the
yep.
mean of X and the mean of Y, and then you have four quadrants. Each one of those quadrants is a partial moment matrix. And you can recreate the covariance matrix by summing the co-partial moment, co-lower and co-upper, and subtracting the divergent matrices. And that was, yeah, nothing short of an epiphany for me. Because then I realized that once you started iteratively partitioning these quadrants, so now I'm in the co-upper partial moment, I'm going to partition that again into four quadrants. And each of those centroids from the iterative partitions started to fit whatever underlying function I had in the scatter plot. And I was like, wow, this is really like fitting this. I was like, I wonder if I can, make a regression function
Yeah.
from these partitions. And I did. And I connected the partitions linearly. And so you have these small linear segments that ultimately fit these nonlinear functions and stuff. So then I also noticed, correlation and dependence that, from the values of these different matrices and stuff, and it was capturing nonlinear associations very well. So I came up with a correlation and dependence metric based off of these partial moment matrices, and reached out to Rishikesh Vinod, who used to be at Bell Labs, worked with under Tukey, and also worked with Peter Fishburne, who happened to be one of the first people in 1977 to associate lower partial moments with stochastic dominance and risk preferences. So I had known Fishburne's work, and I didn't know Vinod, and we had a discussion about regression methods. It was actually more of an argument. It wasn't really a discussion. He's like, "Oh, we use kernel regressions." I'm like, "Oh no, I think my method might be a little better than that." And so we tested it out, and again, this was everything. I had everything in Excel in these macros. It was just a total mess. And he was interested in the method and showed like, oh, well, this is kind of like setting a dynamic bandwidth from these partition levels, and it's interesting. And so we examined the properties of it and wound up writing several papers on the regression method and extracting partial derivatives from it, and then generalizing to the multivariate regression, and multivariate partial derivatives, and all sorts of different stuff. We had several papers, and he was the one who convinced me to get everything in R, because he had worked at Bell Labs,
Yep.
which was S plus,
Yep.
and he worked in R. And so then I learned R, and I started coding all of these insights and routines into an R package. And once I had everything in R and I was comfortable programming R, the insights just kept flowing. Well, what if I use this regression method in a time series method? So what if I come up and use this regression method in a vector autoregression method, and leverage both the time series and the regression method? He had a couple packages he wrote in R that he had me look at. One of them was his maximum entropy bootstrap package, which is a bootstrapping procedure just for time series. I mean, it generalizes to everything, but
Yeah.
you retain the properties of the time series. And one of the criticisms that he got was every replicate had a unit correlation to the underlying series, which was, not bad per se, but it wasn't desirable. So I figured out a way to specify a correlation metric that for all of the replicates in his bootstrapping procedure. So now you could say, oh, give me something that is, negative 0.7 correlated to this time series. And so it generates replicates negative 0.7 time, rho equal negative 0.7. Or, you can sample from -1 to 1. Like, give me the whole correlation spectrum.
Yeah.
So I had gotten into R and all of these stuff, and it was incorporating everything into the NNS package. He's like, why don't you just come here for a PhD, meaning Fordham?
Yeah.
So I hadn't given it much thought. I didn't really want to teach, but I really liked researching and working with Rishikesh on all of these, applications that were, new and exciting and interesting for me. So I said, sure. I had to take a GRE test to get a score.
Oh, yeah. I remember
I
they
hadn't
did
sat
that.
for a test for, I don't know, 25 years at that point. And I wound up getting a perfect score on the GRE math test. And then the admin from Fordham, she's like, you don't want to come here. She's like, you can go anywhere with this. I'm like, no, like I'm already entrenched and working with Rishikesh on this stuff. I'd like to see this through.
Yeah.
So I went into the Fordham program and used it more of a review of literature to the existing methods that I had developed over the last several years.
Yeah.
And to like polish them up and fine tune them, because they offered much better insights than classical methods. So my whole prior part was, let's compare methods and do, one-on-one analysis. The Fordham experience taught me the review of literature and all the underlying stuff to what I had already developed. Ultimately, it's not what I wanted. I wanted to implement this stuff in, portfolios and options modeling. So wound up leaving the program early, and had these ideas that I can really apply them to very different parts of finance. So I had a new options model that used upper partial moment for calls, lower partial moments for puts, where you're leveraging the maximum entropy bootstrap for simulated returns. And
Hmm.
so it's using all of these tools that I built and shared in the NNS package and applying it to different parts of the market. So there's an options model. There's a macroeconomic nowcasting model, which uses the nonparametric vector autoregression that leverages both my time series and my regression method. Um, and then there's a portfolio tool, which uses my utility theory work and embeds subjective preferences into the covariance matrix directly. And, then I could optimize portfolios which satisfy those preferences instead of having or assuming a utility function that you're, quadratic or risk averse or anything.
Yeah.
Um, so then I spent some time building out all of these apps while simultaneously making NNS, more capable, bigger, faster, stronger, learning C++ to make it more capable on larger data sets and stuff. So it's been a lot of coding and learning to code. And now with AI and LLMs, I could have used that like 5 years ago. Like,
Yeah. Yeah, definitely.
um, no, so it was a lot more, Stack Overflow and looking for analogous problems and how do I customize this to what I'm trying to accomplish here.
Hmm.
Um, but again, so very different procedure now that these kids have with LLMs and stuff. You really learned all of the best practices by rolling up your sleeves and doing all the hard work along the way. And I don't see them recreating that.
Yeah, and I think that's going to be part of the issue. I think it's going to be LLMs can generate interesting things, but I think it's like math. To argue this in the case, the hardest part of math is coming up with the problem. It's not making the solution.
Mm.
And I think that's part of the same process here, where it's like, we have tools, we have things, right? Even have LLMs can answer questions, but if you can't ask the right question, you don't have the right problems to solve. I think
Right.
that's where it's going to be the break. And I think that's why even when you look at things like, oh man, you go to like Black-Scholes pricing, and it's like the equation's simple and it has too many assumptions, and we all agree it's dumb, but it's beautiful because
Yeah.
it's so simplified and it relies on a set of theoretical understanding of how the pieces move and operate as a machine together. And I see students will say, "Hey, I took a bunch of data and I used machine learning and I did option pricing." And I'm like, "So great. So how are you looking at the deltas and how are you going to do Vega hedging and like how are you going to look at all these pieces?" And they go, "Well, I don't care. I just wanted to get the price." And then I'm like, "Right, you're missing the problem we're trying to solve to get to,
Yeah.
often just trying to hit that number." And I think
I,
that's where
I
you're at.
I think you're really hitting at the interpretability aspect or lack thereof.
Yeah.
And one thing about NNS and its underlying methods is, you know, I look at interpretability for features and regressors as, partial derivatives, instead of Shapley values or or something along those lines. And they vary over, different locations of regressor support. And to look at is just an average of the entire support of the regressor is, short-sighted.
Yeah.
Especially when you have these nonlinear relationships and stuff like that. And I don't know how people are you know relatively ascertaining that information from these machine learning models with that are essentially black boxes and they can't deconstruct.
Yeah.
So if inherently I treat everything as a giant nonparametric regression. So in that regression, I can pull out now multivariate partials for any feature or regressor.
Yeah, that makes sense. And so then did this all then get rolled into Avo Labs? Is that kind of the premise?
Yeah, so now instead of just giving away all the code and being like, you know what, this is my contribution to the world. I'm trying to set up a mechanism to distribute the outputs from these insights and all the best practices that I've learned over the years, going back to, what I witnessed at the racetrack back when
Yeah.
I was a kid. Um, so I had sent my utility work to Harry Markowitz in 2010. Totally unsolicited email. I was like, what the hell? He's never going to hear from the guy. But his work, The Utility of Wealth in 1952, like resonated with me the most when I was researching utility theory. So I named my paper The Utility of Wealth in an upper and lower partial moment fabric. I don't know if it was the title or what, but he actually took the time to read it. And then he got back to me.
Okay.
And he was interested in the work. Um, and it sparked this multi-year correspondence. He wrote me letters of recommendation, both for, when I wanted to work at Goldman Sachs and as well as the PhD programs I applied to. He had written me letters of recommendation. And eventually I shared with him how I tie everything into portfolio theory. And he told me that I have a general portfolio theory of which mean variance is a subset. But he felt it was too difficult for the average pension board person to implement and really get their head around. And he said, I'm going to have a tough time selling it because it is so complicated.
Right.
So I took those words to heart. One, it was a great compliment to have coming from him. And two, how do I make this more approachable for like an end user? So I built out these web apps, which for the portfolio method, series of questions to ascertain your risk profile,
Hmm.
translate that behind the scenes into your partial moment configuration, both your degrees and your targets,
Right.
apply those degrees and targets into my covariance decomposition,
Hmm.
take that covariance decomposition, and then optimize a portfolio based on that representation from your specific risk preferences. And I think I've succeeded in making it fairly painless for the end user. Some people would say too dumbed down.
Yep.
But there is an exceptional amount of math and computation going on the servers on the back end for ultimately the final product.
And so then the struggle of this, so you're currently looking for investors, right? It's been this process of trying, this is a long journey. I think it's a good lesson for a lot of people, right? You don't just come up with an idea and turn it into a business overnight.
Uh-uh.
It's this process of building and taking feedback and going through the challenge. And as you've kind of looked at, you interact with an academic here, you interact with a company, another academic, and it's this process of fine tuning and getting it down to like a core product line, right? And that's where you're at.
Yeah.
You have these three core products now because you have the nowcast macro forecasting, you got the portfolio optimization tool, and then you have the option pricing tool, right?
Hmm.
And so now the hard part is getting that capital to get the business off the ground and get it running.
Yeah, no, and again, so I've spoken to a few marketing people, and every marketing person has a different track I should go down to in order to market it.
Oh yeah.
Um,
And if you just pay us 100,000 a year, we can help you out.
yeah, I wish it was that low. Um, no, no. Maybe back in 2005 it was that low, but it's unfortunate because it's all of this leveraging this statistical toolkit that I built out, which parses the variance and allows itself insights on nonlinearities that you presently couldn't take. So you can apply this, again, the NNSR package probably covers about 90% of applied statistics because I've rewritten everything with the sigma in it. So I have these three apps now because these are three areas of finance that I was most familiar with. I am sure that there are more apps and applications that I haven't considered yet,
But
because be, because it's just my inexperience directly with that part of the business. One, I've had a couple conversations on transaction cost modeling. So naturally, fills above and below or should be treated differently because that's different price enhancements to you. So that's another application. Recently, I've just had those discussions about trying to model that in a partial moments framework.
what's the package called? Because this is freely available on R, right?
Correct. NNS, nonlinear, nonparametric statistics.
Okay, it's just called NNS.
Yep.
Okay, I'll put that on there because I think a lot of people listening will find it interesting.
Hmm.
And I think even some people are looking for research ideas. Right? Like the tools are there, obviously not how to get to the actual optimization, the portfolio optimization, all that, but you have the bones provided in this package here for people to kind of explore and start to work with.
Yeah, so I've open sourced all of the general statistical work, and then all of the quant finance applications I've retained.
Correct.
So that's
Yeah, gotta make a
um
living off of it somehow.
yeah.
Gotta be good business.
um yeah, so I'll refer people to the video link which gives my presentation. Hopefully you put that in the
I'll,
description
yeah, I'll
too.
put it in the description here. People can look it up.
So on my website I have an hour-long presentation explaining, partial moments from first principles all the way through portfolio application. And I also have, an AI review of the transcript, which you can further query. I also have an AI review of the whole NNS package, to get more of the R code implementation and what's going on that you query, as well as the slides for download. So people can go at their own pace. I built a GPT out in order to answer questions, because I had gotten a lot of questions over the years, and specifically through like LinkedIn and stuff, and LinkedIn messaging is just not the best medium to exchange these ideas.
Yeah.
So I built out a GPT where people can go to and specifically trained on NNS and the stats papers and stuff. You can answer questions there. And yeah, again, it is what it is now, but it could still be so much more.
Yeah.
That's the exciting part. You could apply this to, different areas. Like I had a reinsurance company who was interested in, minimizing downside exposures. So I was like, oh, you could do that with the co-lower partial moments. We can build a portfolio and substitute that matrix in for, the covariance matrix and a minimum variance optimization and stuff. So again, these are things I touch upon, but until you're comfortable partitioning the variance and understanding why you're doing it and understanding how now you recreate your classical equivalences, it won't matter to you. But if you appreciate the differentiation between downside and upside volatility and what it could do for you, then I don't see how you go about working in finance without partial moments.
Yeah, definitely. So for one final question here, what advice would you give to someone who has a great idea but wants to turn it into a business?
See it through. See it through. Take all feedback, and there's nothing worse than submitting a paper for peer review and getting trashed in your review, but them not actually finding anything wrong with the underlying math in any of the work. Just, I've had papers rejected because of the tone, read more like a blog post than a paper and stuff. And I kind of blame my co-authors on this because I didn't benefit from publishing anything.
Yeah.
These two academics all were in the publish and perish cycle, and I had inundated them with papers and backlogs of papers to work through that you know they really couldn't. So a lot of them just sat there in like preliminary form, and stuff. But to someone who's starting out with an idea, see it through. Um, just be you, stay true to yourself and what you believe in, and don't get afraid. Don't be afraid to say no if it doesn't align and correspond with your vision of where it's going. Tell your story and show what you bring to the table,
Yeah.
and why it's a better method.
Awesome. Thank you, Fred, for coming on.
Well, thanks for having me. I enjoyed this. Could have went on for several more hours.
Oh yeah, we could have went down the rabbit hole of technical topics.
Oh yeah. That'll be a follow on.